Hello. This will be my last video on working capital. If there's anything you believe I've not covered, you can send me a message or put a comment and I will look into that. But I think we have dealt with the key concepts in working capital. And I will just do a quick recap before I solve this last question. We've looked at what cash operating cycle is. Cash operating cycle, very important. We've looked at EOQ. We have looked at Miller-Orr concept. This is for managing cash. EOQ is for inventory management. We've looked at early settlement discount. We've looked at overtrading. We've looked at bulk purchase discount for inventory management. And we've looked at factoring. Yeah, we looked at cash budgeting, BOMO, and all of that. But yeah, those are not quite big in working capital, especially for these exams. These are the 7 key concepts you must understand, and you must be able to solve questions on these areas to do very well on any working capital management. I know I've done a question on this and I've posted it. I've done this one as well. I've done early settlement discount. I've done factoring. So today I'm going to do this question, which is Wobning. Wobning will cover Miller-Orr and overtrading. And we'll just focus on those 2 concepts, which this question will help us. I mean, in terms of theoretical part of it, I've done videos where I've done the explanation on that. But I always like to solve questions, especially exam question, that you will be able to see how examiners might actually try to assess your understanding of this concept. So we have been given this financial statement of Wobning. This is the P&L, and the statement of financial position is also given. And this says that the average ratios for the last 2 years for companies with similar business operations to Wobning as follows. So this data relates to the industry average. And the first requirement is to use suitable working capital ratios and analyze the financial information that's been provided to evaluate whether Wobning can be described as overtrading or undercapitalized. Remember, another name for overtrading is same as being undercapitalized. So I will just do a brief recap on overtrading. Remember when I dealt with overtrading, I said you must know the problem, you must know the symptoms, and you must know the solution. And we said the problem is we have a company that has so much sales activities. That are not supported by enough very important long-term fund. That is the problem. And how do we know that a company is overtrading? Those are the symptoms I want to look at, and that is what this question is testing. It's actually testing symptoms. What will you see? And we said the first one is the fact that huge rates of increase in sales. Sales will go up from previous year tremendously. Likewise, the current ratio will be bad. It's going to be less than average. The same thing is applicable to quick ratio. Right? We also said that account receivable, inventory days, and AP days all will go up because those balances will go up because this company is selling so much. It will need so much inventory, will try and delay payment because it doesn't have enough cash. So AP balance will go up, inventory will go up, and AR will go up because it's selling so much on credit. Right? We expect all of that to go up. And likewise, we expect the short-term funding to go up. Things like overdraft. Short-term fund will go up. And lastly, long-term fund will deplete or will remain the same. But it will not go up significantly. So these are the 6 key symptoms that you really want to look out for when you want to assess a company, if it's overtrading or not. These are the 6 things, and those are the 6 things we're actually going to be looking out for. If you look at the question, the 7 marks question. So any 5 of these will hand you your mark for sure. Yeah. Do the ratios and you do the interpretations for 5. You will have your 7 marks in full, right? But I will go through all the 6 symptoms so that you can understand how you can assess whether a company is overtrading or not. Yeah, you can pick anyone that you feel comfortable and easy with. So let's start with the expected increase in sales. So number 1, let's evaluate sales. If we look at the statement of P&L, we see that sales has moved from 10,375 in 2010 to 14,525 in 2011. So what's the percentage increase? Let's calculate the percentage increase in sales. So that will equals to 10,525 minus 10,375 divided by 10,375. Press the calculator. That gives us about 40%. That's huge. That's really huge. Because we're wondering why is sales going up by 40%. It's terrible because if you check that against the profit, right? Simpler terms. Let's look at it. Profit before interest and tax. Has it gone up by that so much? Look at profit before interest and tax. If you calculate the percentage increase in PBIT, that is just 4067 minus 3735. Yeah, this is it. This place divided by 3735, and that will give us just 9%. So look at this. Sales went up by 40%. It's really bad. Yeah? Really, really bad to have sales gone up 40%. However, the profit before interest and tax has only gone up by 9%. So, in as much as this also shows that the cost management is really terrible, but you can as well see that the revenue that has gone up by 40% has not translated into a better fortune for the company. So that's first signal, but we can't conclude based on that. Let's look at other factors. Number 2, current ratio. remember how we usually compute current ratio? We said is total current asset divided by total current liability. And we have a current asset of, the current asset, our current asset is 5349. And current liability is 4365. Put that on the calculator. That gives us, I think, 1 second. That gives 1.2. Thereabout. Yeah, 1.2. Ideally, the current ratio, you expect an ideal current ratio to be 2. So you already see a signal. This is 1.2, is less than ideal. And beyond that, even the peer in the industry, as given in the question, is doing 1.7. So by all means, this company is doing worse than ideal and also worse than the industry. So with these two reasons, it's still tending towards overtrading. But we'll go ahead. Let's look at the third ratio, which is quick ratio. Quick ratio is similar to current ratio, but we call it asset test ratio because this ratio tries to eliminate the inventory, which is usually seen to be less liquid. In terms of current asset. So this formula is current asset minus inventory balance divided by total current liability. And that will be, because we only have 2 items of current asset, so that was just account receivable left, and that will be 3200 over 4365. And if you press down calculator, we have a quick ratio of 0.73. So ideal is 1. That's ideal quick ratio. So we have less than that, and industry is doing 1.1. So by all means, this company is not doing well in terms of its current ratio because it's only doing 0.73. That is also confirming that this guy is overtrading. But let's keep going. Let's assess the AR, AP, or the working capital components. Starting with AR days. AR days is AR balance, which is 3200 divided by sales revenue of 14,525 multiplied by 365 days. If I put that on calculator quickly, that 3200 multiplied by 365 divided by 14,525. We have 80 days. Let's see, what is the industry doing? Industry is doing 60 days. So peer is doing 60 days. You can see that the AR days is greater than the peer. So that is also bad. Let's look at, so this is A, look at B. Let's look at inventory days. In a similar way, The inventory balance we have is 2149. We divide that by cost of sales. Cost of sales is 10,458. Multiply by 365 days. Let's see what that comes to. So 2149 divided by 10,458 multiplied by 365. We have 75 days. And let's see what the peer is doing. Inventory days for our peer is 55 days. You can see the company is doing more than the peer again, which is also bad. Let's look at AP days. So for inventory and AR, it means that this company has so much inventory and receivable balance, more than you expect to have in the industry. So that tends toward the conclusion that is over trading, because it must have been selling so much to be keeping so much inventory and to be having a lot of account receivable that has not been collected, so he doesn't have cash. AP days. Now let's look at AP days. Let's see what is going on with AP days. AP balance. Our AP balance is 2865 divided by cost of sale of 10,458 multiplied by 365 days. Let's see what that comes to. 2865 divided by 10,458 times 365. That's 100 days. That is huge. 100 days. What is peer doing? Peer is doing 85 days. Very bad. You can see. Our peer is paying within 85 days. This company has to delay its own payment by 100 days. That's a lot, because that's part of short-term funding, because it couldn't access long-term fund. And let's see other options that we're looking at to assess this guy: short-term funding and long-term funding, 5 and 6. And this we just nailed it for us. Short-term funding. We already saw that AP has gone up. Now let's see what has gone up with overdraft. If we look at the overdraft balance has gone up from 250 to 15. So that is percentage increase of 15 minus 250 over 250. That is 500% increase in short-term funding overdraft. That is a lot. And let's look at long-term funding. If you look at long-term fund, the long-term liability remains at 4 million. And no new shares has been issued, no funding coming in. So this stays the same, no change. So they've not been able to increase long-term funding despite increasing sales by 40%. So with all of these 6 scenarios that we have looked at, you can confirm that Wobnig is definitely over trading. But there's none of these factors, none of them has given us any doubt. It's crystal clear that's over trading. So anytime you have a question checking whether a company is over trading or not, these are the ratios that you have to compute. Yeah. And you have to always compare them either with the previous year or with industry average. If you have industry average, is the best thing to compare with, right? And that is a clear indication that this company is over trading. The first thing is the fact that the sales has gone up by 40%. That is not good enough. Yeah, the sales by 40%. You don't want to see that. Current ratio less than the industry average. Same thing, quick ratio less than industry average. And we look at working capital items. Account receivable days longer than our peer. Inventory days longer. AP days longer. Overdrafts has jumped up by 500% short-term funding. Then no change to our long-term funding. Yeah. So with that, the conclusion is apt that it's overtrading. So that's the first part of the question. The second part, which is B. The B question is looking at, well, let's look. So Wobnico is considering using the Miller-Orr model to manage its cash flow. The minimum cash balance will be 200,000 and spread is expected to be 75,000. Remember when we spoke about cash management? There are 3 ways to manage cash. I told you can use Miller-Orr, you can use BOMO, and you can use cash budgeting. Yeah, but this is what this question is testing, Miller-Orr. Now, with this question, we have the minimum cash balance, which is minimum level, at 200,000. We have spread given as well. Lucky. 75,000. Those are the 2 information that we have. But we have been asked to calculate the upper limit. And we also have to calculate the return point. Then we will need to explain. So 3 things. Take note that we have to do. Explain how this will be used to manage the cash balance of Wobnic. Right, so let's do upper limit. Upper limit is equals to lower limit. If you remember the formula plus spread. So with this, upper limit will be equals to 200,000 plus 75,000. And that will be equals to 275,000. So that is the upper limit, which is the maximum level being asked to. The second one is we're asked to calculate the return point. Yeah, return point is equals to 1/3 of spread plus lower limit. So that equals to 1/3 multiplied by spread of 75,000 is given. Then plus lower limit of 200,000. 1/3 of 75,000 is 25,000. So that will be equals to $225,000. That is the return point. So we've calculated the first one and the second one. The third part of this question is to explain how this will be used. Yeah, if you remember how we dealt with it the last time. Yeah. So we have our cash level, set a return point. Let me use a different color for return point so that's clear. So return point, we'll put it here. So we said return point is 225. And the minimum level use minimum level. Yeah. Let's use yellow for minimum level so it's clear as well. So minimum level at this point. Minimum level was given in the question at 200,000. And the maximum level we calculated is 275. So this is maximum level. So this is max, which is upper limit. Yeah, and this is return point, and this is the lower level. It's upper level. Right. Now, how do we interpret this? What we're saying is, anytime, so the interpretation is that when cash is lower or gets to 200,000, Wobning should sell or divest. Short-term investment, sell short-term investment of about, that'll be like, if it gets to 200k, you need about 25,000 to get to return point. So investment of about $25,000. 25k to return to 225. And also, if cash is at maximum level, which means gets to 275, yeah, at 275k, then you ask Wobning to divest. So they have to invest. They have to invest the money, the excess cash of, remember, we want to come down to 225, so the difference is about 50k, yeah, of about 50k. So invest the excess cash about 50k to restore cash balance at return level. Those are the two things that can be done, and that's the way Miller-Orr is being used for cash management. If you have any question, please feel free to put it in the comments, but please watch, share, and remember to like. Thank you. Next video, we'll be talking about another part of the syllabus, and that will be it for working capital. Bye.